Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, active or passive, maybe you are just in the industry, you want to stay up to date with everything that's going on. Fortunately, you're in the right spot. Every single week on the Gray Report, we're breaking down all the latest research reports, data, articles, and then, summarizing it, breaking it down, giving you some original opinions from the Gray Capital team. Strap in. Got two really important pieces. First off, CPI printed this week. We're going to break down CPI, what it means for interest rates, the economy, what it could mean for multifamily and commercial real estate, but also parsing it to see, is it as bad? Because it was a hotter print than we thought. It definitely came in higher than what was anticipated. And if you know, everyone's they're waiting. When are interest rates going to come down? How quickly? And if you are holding out for interest rates to come down, like in March, in terms of the Fed fund rate, a lot of cold water thrown on that idea. If you hadn't come to that conclusion, this put a nail in it. But what it's going to look like for the rest of the year to see, are we going to see a recovery at the second half of the year, Q3, Q4? We're going to get into that a little bit, specifically looking at shelter, which we know a little bit about because we cover shelter a couple times a week here on the Gray Report. We actually do it every single day in our real jobs. Not that this isn't a real job, Matt. Also, a piece from Bigger Pockets throughout this article last year as well, but it's from Scott Trench, the CEO, basically looking at, commercial real estate. Is it going to crash? Are we going to see a major commercial real estate crash? And he lays out a couple reasons why. We're going to push back a little bit and see, why it may not actually kind of be a crash the way he's laying out. He makes some decent points, but not all of them hold up. Stick around. It's going to be a great episode. Let's get into it. All right, let's go. All right, welcome back to the report. Joined again by Director of Communications and Marketing, producer of the Gray Report, Dr. Matt Bosnagel.
Hi.
How's it going, Matt?
Pretty good.
We're it's a nice day, beautiful Indianapolis at the Gray Capital headquarters. First, before we get into the CPI report, Matt, it's a little bit surprising. It's the perennial discussion of where interest rates are going to go, inflation. But first, Gray Capital, we've got a new deal. It's open for accredited investors. If you've been following along with Gray Capital on the Gray Report, if you kind of like the way we look at the market, look at deals, we're buying value-add core plus assets in the Midwest. Got a really exciting opportunity called River Club. It's a value-add project in Evansville, Indiana. It's a $45 million deal. We're raising about $20 million. If you'd like to participate, again, if you're a accredited investor, hop on over to graycapitalllc.com/new-offering, or you can just go to graycap.net. You'll be able to find it really quickly. Create an account on the Gray Capital portal. We've got a whole deal room for you so you can do all your own due diligence, dig into the deal. We've got videos, we've got underwriting, we've got decks, we've got everything you'd ever want to see, learn about us or the deal. So hop on over to graycap.net, sign up for the portal, check out the deal, schedule a meeting with the investment team, have a meeting with me and the rest of the folks here at Gray Capital. We'll get you set up and see if it's a good fit. All right. Enough of that though, Matt. It's really exciting. We're having a lot of fun working on that deal. But let's talk about CPI. Came in a little bit hotter than expected. Give us the breakdown.
Okay, yeah. Well, so hotter than expected, that you're already dealing with expectations and kind of interpretations of it. Nominally, inflation, year-over-year inflation went down and has continued to trend down for, the past year, however long.
Yeah.
For a long time, it's been, the dominant trend is that it's going down. The problem is that we expected it to come down a little bit more strongly this past month than it actually did. Now, the monthly difference, so really we were expecting the inflation rate to be 0.2% month over month for all items, and instead it was 0.3. So I know that if you extend that 0.1 difference out from but still
pretty close.
I don't know.
Yeah. And then again, it comes back to, and not to steal the whole point in your thunder map, but it's this shelter component, right?
Yeah.
That Jerome Powell himself has said, we know where the rents have come down materially. We know the rents are negative, where they were negative last year. They were negative, start the second half of 2022. As again, Jerome Powell said, we just need to wait for it to show up in the data. And then, just turning the shelter component on, you can see how the rest of CPI has come down quite a bit. Going all the way down to kind of this kind of 3% range. But shelter, it has started to come down, but only a little bit. But what we know is, if this is, it's arguably, people said 12, looks like it's seeming to be more 18 months at least of a lagging indicator behind actual rent declines and shelter declines. Why we don't know, I guess, the rate, although this rate is relatively kind of consistently down, Matt. We definitely know that it's going to keep going down, and I don't see any way that all of a sudden it spikes back up, because we know how it happened with rent growth over the last year and a half, and shelter makes up like 0.34% of all of CPI. So that's where, again, Jerome Powell, they're confident that they will be able to lower rates at some point. They don't want to come out and say they're going to do it too soon. Most likely, they're saying it should still be this year with potentially, multiple cuts. Sorry, shelter's 36% of CPI. But if they just have to wait for this to get into the data, I guess the question that many are asking and pushing for is that if you know this, why wait for just kind of an arbitrary metric? I guess the concern, though, is that, if the economy truly overheats, and we could have, where does the neutral rate end up shaking out at? And they would prefer it to be at 2%. They don't want it to shake out at 3 or 4. Although I don't think at 3% it would be the end of the world by any means. But they really would like the neutral rate to shake out at 2%.
And I think that the other narrative that we're dealing with here is this last mile narrative. The last mile of interest or of inflation is always going to be pretty tough to get rid of. The Fed has said as much, and also, I think some of the reason why people were reacting, we spoke about this earlier, is because if inflation's running hotter, then we're not going to get that interest rate cut in in the next month or so.
Exactly.
And I think that the Fed has telegraphed their intentions for so long. It's hard to share in the emotional response of the market. Like, they're planning on long-term data, and I don't think that the Fed is going to be shaken by 1 month, especially a month that is still nominally an improvement in inflation compared to last month. We're in this bumpy ride on the way down, and there's nothing that really there's nothing compelling that would go against that right now.
No, I think that's a really good point. The Fed is not thinking in month over month data. They're not even thinking really in quarter over quarter data. I mean, their periods are more like half of a year periods. And we're at least seeing trends kind of at that rate. So just one little piece of data, it's just one little piece of data. It could, again, distinguishing the the signal through the noise. I mean, there's a lot of noise in this data, especially when we know some of it is lagging, maybe even not 100% accurate. But also, point that you made, Matt, is that surprisingly there were still a lot of folks out there that were hoping for a March rate reduction. Most people in the market had kind of pushed that off. No way that that's going to happen. I mean, it was consensus that it might have been a rate cut in March, a month ago or so. I think we were downplaying that quite a bit. Now the consensus is, pushing it out closer, to, middle of the year, second half of the year. How much and how soon, I don't think we know. I think that that's obviously going to be a major inflection point. The time when they do decrease the Fed funds rate. And also, then coming back to real estate and multifamily and the broader markets, I mean, the first, signal was, hey, we're looking at lowering rates. That they actually said that back in November. When they actually do, the floor is going to be in on any sort of price declines. I'm talking about real estate and multifamily, not necessarily office and some other stuff, but specifically multifamily. There's so much dry powder. but that's been on the sidelines. There's waiting to see opportunities.
Yeah.
A lot of people wanting to see distress. There's going to be a lot of disappointment that there's not going to be as much distress. Banks are modifying loans, extending and pretending, not wanting to write things off because they don't want to face the music themselves with their own balance sheets. So it's really pushing a lot of this distress off. And, lower rates, they're not going to solve everybody's problem, but it certainly is going to make things easier for some folks and lessen the pain for some. And so it gives some hope that later in the year, we could have a market that really is coming back to life, which it feels like. And again, we're in the middle of a capital raise right now. So I can just tell you anecdotally, there's a lot of interest from investors to invest in deals.
Yeah.
We're having the most successful, close ratio of conversations to yeses in the amount of time investors are taking to give us a yes is as short as it's ever been on a deal.
Yeah.
And it's so starkly different from 6 months ago where people were telling us, I want to invest in real estate. I like multifamily, but right now it's tough. It's uncertain. I just think I want to wait a little bit. I want to invest with you guys, but I just don't know. I'm just not sure right now. Maybe next year. And now we're here. It's next year, and people are they're ready to go.
Yeah, I mean, CBRE, I keep thinking back to it because it's an important contrast from last year. They did an investors' intention survey in 23 and 24, and it is the inverse from year over year. Most of the people said, I'm not going to buy or sell this year. That's what they said in 23. 24, the same skew was, I'm going to buy and sell this year. So there is, I think, I don't even want to say excitement in the market. It almost seems like there's a lot that's mechanically set up to start investing once rate cuts come. And so the question is there any way, and again, I've mentioned this before, who's going to get ahead of it? That's going to be the interesting moment of the market to me, is what happens before rate cuts come. What are people going to, I don't want to say speculate on, but what are they going to invest in is a little bit more of a pointed question.
And because, many investors are looking at, maturity risk of their bond portfolios. They've been in, probably, a lot of 2-year short-term treasuries, because they were a great buy over the last year or so, or they're in money markets. As rates come down, they're going to be looking to replace that income. Oh,
that's very interesting. Okay, so it is kind of a mechanical, no, I want to get, oh, wow. That's particularly interesting.
I mean, because again, let's say you were concerned about the economy or whatever, or you had cash. Let's say you did some tax loss, harvesting, selling some stocks that had gone down. Well, where are you going to put that? Maybe you weren't too crazy on the stock market. You'd put it into bonds, or you'd put it into money market accounts. Throwing off a good return, you can earn 5+%, 5.5%. Okay, well, that's not going to go on forever. And as we've talked about, when rates decline, not if, when, maybe it's looking like this year, who knows when. But when that happens, you're going to have to replace that income, especially if you're, because the money market returns will start coming down automatically. Yeah. And when those bonds mature, you got to do something with that money. You could reinvest in those bonds, but they're going to the coupon's going to be much lower. And assuming that there are real estate opportunities being purchased at attractive valuations, which we're starting to see some of those emerge, where there were none a couple of months ago. We're starting to actually see some good deals. If the market's adjusted and you can get decent cash flow, all of a sudden, multifamily looks like that great alternative it historically has been. It hasn't looked that way in a tightening cycle. And it comes back that you don't fight the Fed. Flow with the Fed. If the Fed is raising interest rates and trying to take down housing, get out of the way of the Federal Reserve. Yeah. But when they're going to be loosening or, lowering the amount of restrictiveness on monetary policy, I think that's a time to jump in, put a point in the cycle where the most money is ever made.
Yeah, I agree, and I wonder too, as you said that you've been seeing some more deals that are more workable pop up in the market.
Yeah, I've seen some decent deals pop up,
and I wonder if some of it too is all right,
some bad ones.
We spent 2023 doing nothing. Let's get real here. And I don't know if it's tough conversations that brokers are having, or maybe just everyone's had their chance. They put it on the market. It didn't get their price. Maybe they took it off, and that is all cycles. So now they're kind of realizing, all right, I've got to do something about it rather than wait around.
Yeah, the stock market's has done really well. So assuming you've got a public equities portfolio, you're looking pretty good right now. Whereas go back into end of 2022, it was a rough year. And again, that time period, nobody really wanted to do anything.
Yeah.
For a decent reason, because they had lost a good 10, 20, 15% on their stock portfolio, depending what they were invested in. They had a great year in 2023. And so they're saying, okay, the stock market may be, debatably expensive. I haven't done a real estate deal in a while. And you have to think about talking, portfolio construction, especially a big family office or anyone that a very relatively sophisticated investor. If you're trying to maintain a portfolio balance of, I see a lot of family offices, 20 to 30% commercial real estate or alternatives. So if you're trying to maintain 20% of your portfolio allocated to real estate, and your stock portfolio has grown over time, and you haven't done a real estate deal in a while, maybe you've had some real estate deals actually sell. I've had a lot of investors. It's like a lot of my deals have sold. I need to get reallocated to real estate. You're looking for an opportunity, but there's only so few out there. So it's for us, again, coming back, sharing this anecdotal, real-time experience of having a live deal. We're in a live capital raise right now. There's not a lot of deals out there. It's kind of a vacuum. So if you do have a good deal, there's a ton of appetite for good deals. I'm not sensing an appetite for marginal deals, but probably a little bit more than there was. Given this sense that, okay, if interest rates have peaked and maybe start coming down, the floor in pricing in the trough is near or potentially even in the rear view mirror in some cases, where we've already bottomed out. We won't know until the future. But if I guarantee you, if at the next Fed meeting, or if there's any Fed speak basically that's communicating that rates are going to come down soon, or at the next Fed meeting, I think in May, if they reduce, March, I guess, they've already announced that they're not going to do it in March at the next FOMC meeting. But I think in May would be the next opportunity. If they announce in May they're going to, there's no more price declines. Because buyers are going to be flooding into the market. The challenge has been, with rising interest rates, and it's even hard right now because the treasuries are still kind of up and down and not sure where things are going to go. It's that acquisition risk. But if you're riding the rates down, it's much easier to acquire rather than trying to climb a mountain of rising rates.
And so that's why it's going to be so interesting these first 2 quarters to see how the market moves, if it moves at all, if everyone's going to wait for what I've been hearing is that, the shiny Class A, the new apartments, I would even say, like, even if it was built in like 2015 or something, like, if it's high end, then those aren't going to be the ones that are in trouble or really as an opportunity to buy. Really, you're not going to get the discounts as maybe
the problem on some of those is they're offering a discount, but on, again, every deal is so different. But how did you buy it? When did you buy it? How did you finance it?
The problem on which ones, the B and C or the A
every
class?
deal, but specifically A class deals, because some are well insulated. They're not seeing much of any problems. Some are, though, because if you bought an A class deal, whether it's 2015 or 2020, 2021 construction, 2 or 3 years ago, and you have a floating rate bridge loan, or if you even have a floating rate, Fannie Mae loan with a rate cap that's getting more expensive, you may have overpaid for that asset, and we've seen a lot of deals when we've looked at it, and the sellers are willing to take up an amount that would basically just get them out of the deal. But the challenge is they still want to at least sell it to break even. And the reality is, right, well, you guys just overpaid for this. You overpaid by like 10%. You were speculating, there was a feeding frenzy. People were paying crazy prices. And it doesn't make sense. So for some of those, it's going to take some time, and it's like, I don't know what your problem is or what your solution is. You're either going to sell at a loss, which is kind of the last case scenario, the last thing they want to do. You're just going to have, maybe you can, again, rework the loan, modify the loan with your lender, or if you can kind of sustain the current cash flow, you're above break even, it's just going to be a longer term hold. You're just going to have to hold on to it for a while and manage it and really, operate the hell out of it to get out of the hole. It's you're not going to be, it's not going to be a quick 2-3 year flip. It's going to be, 5, 6, 7 years.
But then on the other hand, there are these other ones that may the bank looks at these A-class, they're like, looks pretty good, seems like you got it under control. We'll just charge you more for longer, and we're not.
We'll just pin the interest on the back of the loan.
Yeah.
We'll reduce your interest. We'll just put it on.
But then some of them, and maybe I'm way off base here, but maybe on an uglier property, the banks will come and say, well, what even are you even going to be around? Is this building going to stand up in the next 2 to 3 years?
Yeah, but do you think a bank wants to take over that and manage it? Do you think they want to manage the contractors and the tenants complaining about the things not working? Yeah, that's the thing. The bank doesn't want to own the properties. They may, and that's the thing with the banks is it's not necessarily like the performance, like it is related to, or the quality is related to the workout. It's much more of the relationship and the bank's ability to asset manage that, and by taking it over, what kind of write-off do they need to do on their own books, and do they want to swallow that pill? Yep. And most don't want to do any of that. They don't want to take a hit on their books. They don't want to manage anything. They don't want to deal with it. Yeah. And so they'd rather, now they may say, you've screwed this up. We want to bring in a new property manager. But you still are going to be on the hook, and you have to manage that property manager. Yeah. So stuff like that. But I mean, sometimes the worse you do, the more you run into the ground, the least chance. I mean, the bank has.
That's what the Fed guidance was when we reviewed it last year. That's what the
Fed guidance was. If your borrower was very irresponsible, make sure you extend more help to them than your responsible borrower, in slightly less trouble.
Oh, well, it's kind of.
No moral hazard there, charity. Matt. No moral hazard coming from on high at the Federal Reserve.
For real, it's a little bit, yeah.
Well, just the bank, and they gave the guidance to the banks for treasuries. They were like, if you're going to hold it to the maturity, don't mark to market. Just don't mark to market anything. Okay. If we all just pretend. And what is society if not just a construct that we create
that's
for
right,
ourselves,
exactly.
So it's on track for the rest of how things work. If we want to be real, it's just for the average person, all of a sudden those rules apply to them, but not to others. But that's
to kind of get a little bit back to some of the real prices in this CPI report, which this was a nice aside, and I think it does illustrate the stakes of why are we tracking the CPI? Well, it's because it is materially important to the Federal Reserve's decision, whether they're paying attention month to month or not. It's still important to
and as we said, shelter is such a big component. I mean, if you think about it, where interest rates are going is dependent on what what has happened in housing. It's all centered on shelter. Yeah. And and Matt, the Gray Report has been at the center of reporting on this. For we've been doing this for 3 years now. Yeah. 3 years. So again, make sure to sign up for the Gray Report newsletter. GrayCapital.LLC.com/newsletter. Just hearing some things that Jerome Powell said. I don't know if he's just getting the newsletter or if he's a subscriber to the YouTube channel. But it rings true. We're on the same page of identifying some of the issues and some of these lags and understanding because if we were talking about energy dynamics or food or some other part of manufacturing, some other part of the economy, we wouldn't have nearly as good of an insight, and we'd be taking it from other experts who knows if what they're saying is accurate or how close to it they are. We're pretty close to it. In terms of what's going on in the housing market, specifically with rents. Yeah. Rent and primary residence or equivalent thereof. And so everyone's watching shelter. A lot more conversation, a lot more watching of commercial real estate in general. I mean, we've talked about this before, the CNBCs, the Bloombergs. Commercial real estate was always such a footnote of every once in a while we'll mention something related to commercial real estate. But now it's such a driver because it's leading to distress of these regional banks. We saw New York Community Bank have some issues last week. Obviously, we know everything that's happened with First Republic and Silicon Valley Bank. Some of that's more related to treasuries, but also CMBS and commercial mortgages. A lot of these are office loans. A lot of them are multifamily loans. We're seeing delinquent loans, commercial real estate loans, tick up quite a bit.
Yeah, a lot of the times when they're talking about this and the greater, and the Wall Street Journal perspective, kind of the larger economic perspective there. They mentioned commercial real estate, and a little bit of it is like a office focused thing, because that's the kind of the exciting thing. But oftentimes they also are lumping in multifamily as well, and I think it's kind of right to do it because they're part of the environment. And if office goes bad, it's going to affect the environment for multifamily.
And 100% correct, but also, office didn't rise as much as multifamily. And so while, office has a lot of fundamental issues, multifamily has different issues where the fundamentals still make sense, but the pricing got so out of whack. There was so much over exuberance and buying at crazy low cap rates, where office, in COVID, no one was getting excited about office. Because people were like, people are already asking, what is the office going to look like? No one's working in offices. Yeah. No one thought that work from home was going to be around forever, but even then it was uncertain. So there's no run up in prices. Where multifamily, there was a huge run up in prices because rent growth was 30%, cap rates compressed down to the 3s and the 4s. Yep. And so there's all this debt that was originated, a lot of it short term, at leverage points that were high, and valuations that represented an absolute peak that current cash flow could hardly support then, and can't support in an era where rent growth in many of these markets has been negative, expenses have blown out, payroll, insurance, property taxes, O&M, turn costs, you name it. Yeah. Every market and every property is different. Yeah. But multifamily, again, while still one of the most favorite asset classes in commercial real estate, and all the data is looking like we're going to have an incredible, decade plus run in multifamily. The capital stacks and the financing and the pricing, you can pay too much for a good thing. Yeah. Like you can overpay for a good thing. Oh yeah. And it can still be a good thing, but you overpaid for it. And we're seeing that a lot today. I'm like, that's a great piece of real estate that I'd love to own, but just too rich for our blood and our and our investors. Yeah.
But so to kind of give some numbers for the shelter inflation that we were talking about, because I think it's super interesting if you think about shelter inflation, for example, just as a category, and the numbers are similar for rent of primary residence as well. So shelter as a category, 6% year-over-year inflation. It was 0.6 month over month. That's compared to 0.4 last month. So it's still pretty hot. Rent of shelter was the same. It was the same story. 6.1 year over year, went up 0.4%. There is room for rent of primary residence for that category. Rents could fall easily another 2.5%, and that's if we're getting to like a 3.5% average rent. So the rent inflation could be and then if it's
shouldn't this go negative at some point?
Yeah. Well, I mean, if it's following it should dip a little bit negative if it's following the private rent trackers. However, I think that the CPI, the highs are not as high and the lows are not as low, so it may not get negative. But even if it
should go lower than, it's not 6.
Yeah. Oh, it's definitely not 6, and it should be. Now, I could be doing the math wrong, but if you're cutting the 2.5% by like a third or whatever, maybe we are owed a 0.75% reduction in overall interest rate. If that's a real back of the napkin math kind of stuff. But
75 basis points.
Yeah.
No, I think that's
just from rent.
That's I think a pretty consensus call. 325 basis point rate reduction. So whatever your math is on track. Maybe.
But so that could cut inflation. And then where are we right now? 3.1% a year over year inflation. That is the overall number. So let's subtract to it. Then we're almost at 2, just from rent. And now I don't know if that is.
Well, Jerome Powell said even without shelter, he said we don't need to see better data. It just needs to not get much worse. We just need to kind of see generally more of the same data. Yeah. We just need to confirm the trend that we are on, which is certainly the case because it kind of, again, just going back to this graph, we certainly were on a steep trend, and then it kind of just
the last mile
so bumpy, just kind of bump to bump.
The largest that I could find. I was pouring over, just finding little funny anecdotes or just funny examples, I guess. Frozen non-carbonated juice and drinks, their prices increased to 9.9% last month.
Frozen,
and
non-carbonate, frozen concentrated orange juice.
Yes, exactly, 9.9%. Dang.
That's, trading places. That's where
That's exactly what I was thinking of. All right, that's funny.
Mortimer. Okay. Also, retail sales came down. Again, this is such small data points.
I included this because it plays into this kind of cauldron of like interpretation, and you can view the inflation is soaring and retail sales tumbling as some kind of like stagflation environment, but it's just two data points that don't necessarily show a trend.
And look at, in the S&P 5 is today closing at a record high. Dow gains 300 points just based on this real quick data point, which shows you how sensitive the market is to just like any piece of data, because
it jumped down, it dipped down after the CPI, and now it's going.
You get bad news, you get some good news.
Yeah.
And again, traders in the market is so high frequency where the Fed is just, this is going to be like ignored unless it's like again, like a 6 month trend. They're not going to really care. We need to see just continued evidence and more of the same. But this is, if we saw retail sales jump, we would be having a different story. So it's keeping the hope alive.
It's like, I'm willing to eat crow here and change my mind and say I was wrong if a trend emerges. But what we're at right now is just 2 points of data for 2 things. There's really not a clear line that is observable, and there's even like a little bit of cushion that can be interpreted just because this last mile is going to be bumpy anyway. So I think we're set up. It is, and also nowhere near as uncertain and weird as it was at the beginning of 2023. We didn't have much to look forward to, or much that we really knew about in 2023, and this year it's a little bit better.
I feel much less cloudy this year than last year. Like materially, where at 23 it was just like, I don't know. I can closer to the end of the year, just because we knew rents had come down. I'm like, well, shelter should be coming down, and it has, just not as much as we think or it has needed to. But with looking at specifically with multifamily, looking at the supply dynamics with, we know there's a lot of supply that's still going to be delivered this year.
Yep.
There was a lot delivered last year. In 2025, first half of the year, there'll probably be some supply, but then second half, it should start trickling off. In 2026, it should be very quiet. Now, maybe it gets spread out a little bit more. Maybe there's some things we don't know about. But again, we have a decent idea of what the dynamics are going to be over the next couple of years.
No, it's going to crash. Multifamily is going to crash.
Well, that's certainly what Scott Trench, CEO of Bigger Pockets, penned, Matt, in this piece. Multifamily is at high risk of continuing its historic crash in 2024. Here's why. This looks like it. I feel like it's familiar, Matt.
Oh, yeah. Well, he even notes that he wrote.
It's because last year in 2023, a very similar piece, multifamily real estate is at risk of crashing. Here's why. So this is more of an update from the piece he did last week.
I appreciate, at least, it's on one hand, I'm like, well, this is the same book report you wrote last year. And on the other hand, it's like, well, he's tracking the issue. But what I think it does, at least if I'm taking a really kind of cynical interpretation, is, well, okay, so he saw it and this is what he's been following with. Maybe that could point to a little bit of a bias and a perspective. But I also want to signal, like, a lot of these, and kind of clear the air here, a lot of the points that we'll review here in his call for a crash, they are really sensitive to one's initial position, their perspective, their bias, and et cetera. And so I want to kind of be clear about my own perspective, and I kind of hinted at that earlier. I was thinking about, what were we thinking? At the same time this guy was thinking about crashes in 2023, I don't think any of us were anticipating a multifamily crash or even really interpreting it as such. We were just frustrated, uncertain, it was inactive. And when valuations did go down, we were waiting for buying opportunities that didn't materialize because valuations weren't down enough. It was like, there's two ways of seeing these things, and a lot of it is dependent, and I'm going to be repeating this throughout our rebuttal to this, is viewing the future, looking forward to the future versus just seeing things that are going to happen like now or in like a couple months. There's a time frame definitely that makes Scott Trench's arguments very valid, but on the other hand, there's another completely valid viewpoint, I think, that's like, oh, this is the perspective that maybe investors are carrying into their buying and selling negotiations.
To me, it just comes off as a little bit of a lagging perspective. That I think that was much more close to being a good take last year. I mean, I think the only thing I would differ for what you were saying, Matt, is we saw the dynamics of interest rates, knowing that would affect prices. Also seeing all the loan maturities coming up, which a lot of there hasn't been nearly as much distress as there could have been because of that, because of all the loan modifications. But the result of the sum of it all has been price declines.
Yeah.
And what he says in the piece of 30 to 35% price declines. I mean, we're buying a property, Matt, that represents a 30% price decline from the peak. So prices have adjusted. It's just there hasn't been a lot of transactions, and not every price is adjusted. There's still sellers trying to get a high price. It's not. The difference between now and last year is last year all of the prices were still high. And then the bid-ask spread was more definitively wide, whereas now it's much muddier with that spread narrowing. Prices definitely coming down, but being a little bit more scattered and all over the place, with some sellers still holding on to high valuations, some markets holding on to higher valuations, some different types of assets holding on, but others that have kind of corrected down, and depending on the certain situation.
I think correction that's the only real responsible way to characterize what happened in 2023 is a correction, because you're also coming off of huge valuation increases in 2021 and 2022.
I agree 100%.
And so and even then, like, I go through so many articles every single week, every single day. I didn't read a single one that said like, oh, the multifamily crash continues. It's like multifamily valuations still keep it. It was not this kind. And again, all of the articles I read are probably biased in their own way. They want to put a sunny face on things, but it's irresistible to write a doomsaying article. On the other hand, and so that would have gotten a lot of clicks. And I did not see I did not see a multifamily crash as a narrative anywhere. It was it was office, it was loan maturities, it was this impending thing. But also, I think that people were like, well, yeah, it could go down a lot, but man, did we make a lot of money in 21 and 22. So
and I guess,
my assessment.
If your definition, and I was like, okay, so what's the technical definition of a crash? A correction is 10% to 20%. Again, this is according to the internet. A crash would be losses more than 20%. Or decline more than 20%. Yeah. So you could say that multifamily has crashed, but I think it doesn't all crash at the same time. Yeah. And it doesn't, and a valuation crash, because in a liquid private market you're not realizing a lot of these prices, because if you don't sell, you really don't feel it. It's kind of it's phantom. It doesn't exist. Is it Fugazi? I don't know. Yeah. Because we're not market to market every single day. Maybe you could.
You can track citrus fruit prices, which I did, and they declined significantly. Yes. But they're not bought and sold like an orange.
So the difference is, there are good prices. So some prices are down, some prices are up. But the idea that it's going to be continuing to be challenging, like that's true, but there's also going to be opportunities. And basically, and let's just get into some of it, the points that he makes.
Okay, so breaking it down, he does give us he does have his own thesis, which I think it's worth just going through his main take. And again, you can know it by the headline, but I think it's worth just kind of quoting him here. He says, unfortunately, I don't think 2024 is going to be much more fun for current owners of multifamily and commercial real estate. There's still a lot of room for this bear market to run, and little reason to believe in income growth or valuation growth in U.S. multifamily at the national level. He does have a good, well-organized article, and he gathers his evidence, ties it all together to make an argument. It fits together, but I want to dig into each of these points. First one, and there's 4 of them. It doesn't make sense to buy apartment complexes at current valuations. The second one, the outlook for rent growth is poor in 2024. The third, expenses are eating into multifamily profit. And the fourth is interest rates will not come to the rescue. If we could start at the first, this valuations claim, I'd love to hear your response. I've got got my own notes here.
Well, yeah, they are if they are, but they aren't if they aren't. And so this is assuming that all the prices stay high and you can't buy. Because it doesn't make sense to buy at peak pricing when interest rates are high. True. This was much more. It's not that it's untrue today, but it's not necessarily universal. Because you can find deals. There aren't a lot of deals. We've got a deal right now that it represents even more because it's a little bit newer property than the comp, some of the comps that we're using. It's a 30% discount to the peak, which is exactly what the projections are looking like. That represents a crash. So it's not the only deal that I've seen. I've seen a couple of deals.
And he's even saying right now, cap rates for prime multifamily assets are around 5%. Or 5.38 if you're going to go with CoStar, but yeah, that doesn't match up with current interest rates. But there's deals out there.
But talking to most buyers, brokers, most of the deals that are trading are going to be in the 5.5, kind of the 6.5 cap range right now. Again, not that a really premium product the deal might not go below a 5.5 cap, around a 5 cap. 5 caps are a 5. A true 5 is about as low as I'm hearing something reasonably selling for today. But most stuff's 5.5 to 6 to 6.5. And again, most sellers still want to be in the 5.5 to 6. But the deals that are really trading are trading kind of in the 6 and 6, plus. The deal that we've got on River Club, is a 6.4% on the seller's T12. Again, for deals that were going for sub 5, it would have gone for a 4.5 cap just a couple of years ago.
Yeah. So a lot of that has happened, and it is interesting. It's like, I don't know what the lag period is or what the adjustment is. I haven't tracked it long enough to know, if it's CoStar, you add a couple percent, or if it's CBRE, you go with this one. But
you just all the cap rate, it's so hard. It's just you really have to go off of, because so many of the surveys that I've seen, some of them I honestly think have gotten better over the last couple of years, but they're so often they're just off. By 50 to 100 basis points, where it's just like, okay, what they haven't, a lot of times they'll get the direction right and the proportionality sometimes, but usually it's like not actually, it's like there may have been a deal that traded for that high of a cap rate, but it's like, I know of most of the deals that traded, and they all traded in this lower range.
And his argument, if you kind of do assume that it's 5%, it is a sound argument. Like, there's no rebuttal to the idea that, like, with a cap rate that low, if your interest rate's higher than that, that's a bad idea.
Yeah.
So
so it's, if you think this is absolutely the case, you just stay on the sidelines. What everyone has to understand right now is that sellers are breaking right now. Like it has started. It will continue to occur throughout this year of sellers facing the music and facing reality of what real valuations. And so this part one breaks down every single day. And if you wait until Scott Trench writes an article saying that multifamily makes sense to buy right now, it's going to be too freaking late. Like, this is the time when this article comes out is when you want to buy.
Well, that's what I thought. Maybe he was writing this so that he could create some deals for himself.
I don't know.
But this is another question I have. Would it be off base to say, would people be interested in selling because they want to buy after it? Or or kind of free up cash or something? But,
100%. I mean, that's why the seller of this property, it's not like really super distressed. They've just owned it for like 17 years, and they're making a lot of money off of it. They would have made more money if they sold it 2 years ago, but they didn't sell it 2 years ago. But they kind of know where the market is, and they have another property they're buying. It's a 1031, and they need to sell it. And they want to roll into the next deal. Okay,
and I wonder, that may be a little bit of an element as the prospects look a little good. Maybe if it's good for buyers, then I'll sell it and I'll buy it.
No. There's a lot of people who miss the boat on selling in the peak of the market, who are like, I'd like to get out of this deal and move on to something else. And now they're just waiting for really interest rates to recover.
So that's another
go down. So cap rates can.
So it's kind of the heart of my rebuttal is to look at the future and not the present. Higher interest rates are driving cap rates high, and maybe there still could be a little bit higher, but people are looking forward, not as crazy as the Dow Jones did. Every time an inflation rate comes in, they're thinking about March and the future. But people are saying like, well, yeah, these interest rates do have to come down. Something crazy would have to happen for them not to, and I think that is a safe non-insane assumption to make. He thinks that rates are going to be at 4.5%. This is later in it, but I think that it's not going to. I think the Fed has their dot plot.
The 10-year or Fed funds?
He was saying that for the Fed funds, and then he was extrapolating.
4.5. Well, 4.5 is 100 basis points lower than it is today.
Yeah, I think that it could get to 4.5. It could possibly get to 4.5 this year, and then maybe is the neutral rate the one was like, we're going to stick with this? Maybe 3.5%. I don't know, but that's not insane. It's not like I'm not being rosy cheeked or rose-colored glasses and trying to say like, oh, don't worry, things are going to be back to the way it was. I'm just saying that it is not at all. I think it's more reasonable than not to suggest that the stuff that doesn't make sense right now is going to improve, and it may be worth carrying those assumptions into your buying decisions. So that's my rebuttal to part
Yeah,
one.
you don't want to over speculate, but you have to at least kind of see where things are going now, where they've been, especially when things are obviously moving.
Yeah.
But I do think that the rates aren't going to get low as soon. This is where I guess I agree with what Scott is saying, is that they're not going to get low as soon as some people wish they would.
Yeah.
Because there's been anticipation that rates would be down at the end of 2023.
That was some of our discussions at the start of 2023. It's like, all right, the rate cuts are going to start this year, right?
That's what a lot of people
did not
thought.
see it. Yeah,
no, did not happen.
So,
all right. So part two, the outlook for rent growth is poor in 2024. That's not. That's not untrue, Matt. The rent growth outlook is not great, but it's so location dependent, though, right? And was more true for 2023 rather than 2024.
I agree too.
But we do have a lot of supply coming online. It's not going to be a great year for rent growth, so it's not untrue. It's just, again, it just seems like it all just seems a little like stale, not untrue. Still, it's still edible. It's just a little. It's a little stale.
Yeah,
it's
I agree. So
it's consumable.
I like that one of the descriptions that he has of the incredible amount of multifamily supply. He's like, the only word I have for this massive supply is an onslaught. He argues that this construction boom is accelerating. So that is his picture of multifamily supply. Is yes, we're going to get supply, but and I'm not even going to. I'll address his his comments on demand too. But he does have a pretty detailed breakdown of the fundamentals of apartments that would drive rent growth and not rent growth. But yes, he says that the construction boom is accelerating. And I don't think that's the way it looks.
What does the data show?
So the data shows if you look at permits and you look at starts, not necessarily completions. Well, first of all, the completions expected in 2024 from a bunch of private sources are less than the ones that are expected in 2023 for some of them, or at least equal. Not necessarily accelerating, because as you can see in this chart here, we have starts, completions, permits, and units under construction, 4 lines in the line graph, and the ones for permits, which happen at the earliest among these things. So this is where the government says, okay, you can build here. It's like not the very beginning of a project, but a start of a project. Those permits are going down and have been going down since really dramatically since 2022 and when the interest rates started rising. And also, since 2022, the amount of housing units started has gone down. These are multifamily units with 5 or more units. That's the metric that people use. So the permits and starts are going down. That to me would indicate that the completions will be going down in the future, and that is the expectation that a lot of different sources are using. CoStar themselves has like 250,000 completions expected for 2026 compared to the 500 or so expected now. So the reason is they're looking at construction guys can't get loans. Just like us syndicators can't get loans. They're not starting building, we're not buying, and things just stagnated a little bit in 2022. Didn't fall off a cliff, but still, very much a slowdown, and you can't say it's accelerating. So that's a hard and true rebuttal there.
Yeah. I just think it's not untrue. It's just a little stale.
Yeah.
And then another part that it's true, but it just again rings a little stale again, which is expenses eating a multifamily profit. This is definitely the case. We've talked about property taxes. We've talked about insurance, especially in markets like Florida, in Texas, even in Georgia, payroll, utilities.
Yeah.
Overall, turnover costs, contracting services. Yeah, it's all gone up. But a lot of that we saw at the beginning of 2023 and 2023. If anything, we've seen prices more or less normalize.
Okay.
Not that they're going down, but they're not going up just like the rest of inflation.
Yeah.
It's more or less normalized. So, the statement expenses eat into multifamily profit. Well, that's always true.
Yeah.
And expenses rose last year, but this to me seems like an issue that is a little bit more in the past.
Yeah.
Now, if you combine it with Port 2, that's like, you've got some decent expenses and rent growth is going to be, basically expense growth and rent growth, maybe you're going to be on par. In some markets, expense growth may be higher than rent growth if you have negative rent growth. The Sun Belt's going to have some challenges. Spots like Austin and Tampa and Phoenix.
He used insurance as one of the major examples. He also used in a strange way that he said that tax increases due to newly assessed value increases are another source of extra expenses. Yeah. And that may be the case. I think the general picture of expenses, at least, and I'm not in the weeds like our property management team or accountant team, but everything I've heard, and even from professional reporting on this issue, is that they're plateauing, maybe a little bit, not decreasing, but definitely the expenses are no big negative surprises expected in 2024 when it comes to like your utilities bill or. But that being said, if you're talking about these tax increases, I think that to cite valuation increases, even if they are, to further your point about rising tax expenses, to cite valuation increases as part of an argument for valuation decreases, that's a mixed evidence,
well,
right?
What must go up must come down, I guess.
Yeah. So, but if your larger point is that multifamily valuations are decreasing, to use evidence as I guess what comes up must come down. That's a good point.
Overbought, I guess.
Yeah.
But not always the case.
Yep.
Yeah. Again, it's a little bit of circular logic, but it's, I don't know. It is what it is. It's
ultimately, summatively, that's nitpicky, and I'll throw that one out. But summatively, I don't think that the expenses is not as strong of a point as it was in 2023.
Agreed, and which is kind of the key point across all these takes. And then same thing. Well, this one I think is mostly true, which is interest rates will not come to the rescue. I think it depends because again, every property is different. Every loan is sort of a little bit different in terms of the leverage and the deal.
Yeah.
When it expires. Yeah, if you bought a 2 cap in Houston and you need the interest rates to come back down to 0 to be able to sell it at a 2 cap again or a 4 cap, nothing's going to save you. Sorry. But if you bought a decent deal and it's on the margins and you go from having to bring a couple $100,000 of cash and refinance to cash out because interest rates came down, it is going to help you. Maybe it's not a full rescue, but it's going to give hope. And I'll give some actually real pushback, I guess, because the idea, not that the interest rates have already moved, but that interest rates will decrease, has given banks the green light and the optimism to modify all these loans. So the interest rates don't even have to lower. It's just that they have consensus and enough groupthink to say, well, we've been told that there's going to be 4 to 6 interest rate cuts this year. I'm like, 6 interest rate cuts? No. They're like, well, that's what we're being told.
Yeah.
And since we're being told that by our smart guy that's above us, our director of market smartness,
I want that job.
Isn't that your job?
That's right.
That's what they told us. And so, we're going to modify loans because we think rates are going to come down. If not, we'll deal with it then. But again, we don't want to write things off on our own book and mark to market ourselves. And we've been given the data points from on high to kick this can down the road. So again, interest rates don't even have to lower. It's just the perception that they will lower has already rescued many borrowers and without the rates even having to come down.
I took issue a little bit. It seemed like the and again, I'm still thinking about like the current moment versus whatever future projections that are coming in to people's thinking when they're buying and selling. So maybe people go in and they're like, well, I'll just refinance. And now that's really dangerous. I feel like to like bank on interest rates going down as part of like your core business plan of buying a multifamily property. But it is slightly an element.
It's not insane to think, but I mean, when we on the deal that we've got right now, we looked at a couple different execution methods, financing and the financing strategies, and we looked at going a bridge to where we would have to refinance in 2 or 3 years, and with some conservative modeling, that objectively was a way to achieve higher returns. And even with some conservative assumptions on the refinance, and again, you could get crazy with the assumption on the refinance and make it look really good. But from our base case scenario, it didn't look so much better that it was worth taking the risk. And so we decided, let's just go fixed rate, even though maybe we're going to leave some money on the table because there'll be a higher prepayment penalty. But where interest rates are going to go, what terms are going to be in 2 years, there's so many variables.
It's too speculative.
It's too speculative. You can do it just to see what it looks like, but it's not very useful. Models are they're the aberration of usefulness. When they're essentially like a little bit more accurate than tarot cards.
That's great. But I wonder, though, if there is a little bit of an expectation that's built into the market, whether it's, the thoughts of brokers saying you can get this price because, I know it's crazy interest rates now, but think about what's going to happen in the future. Or that could just be a factor in discussions. But what Scott Trench seems to be saying here is that interest rates are not going to fall much further than the 4.5% that they are. I agree. I think that rescue is a good word because this is an issue.
If you're counting on it falling further than 4.5%, you need it to.
If you need it to, if you want
up the river without a paddle.
Yeah, exactly. Like if you're in that position already and you need to be rescued, that's not going to happen. But in terms of like if you're a syndicator and you want to keep your business going and still keep the acquisitions and if you're looking for things to buy or something, like there's a potential for deals to make sense. But you probably aren't going to assume that it's going to stay at 4.5% for the next, for 2025 and on. But that he seemed to imply in here that it would stay at 4.5% for longer than after 2024. I'd like to scroll down, but
I don't think he's necessarily incorrect on that. Again, we don't know where interest rates are going to be in a couple of years from now, but I think that we've got a lot of growth going on in the United States. I think we're going to see we're going to have a decade of a little higher growth, higher inflation, and slightly higher interest rates, which is kind of much more normal than the last decade we had.
And I rebut my rebuttal. I'm sure that Scott Trench will.
No, it's a well put together piece. Again, I think that he was spot on last year. I think that there's a little bit more nuance, and he gets into some of the nuance. But I think that we're starting to see some of the market break that some of these assumptions were based on. Again, some of these I think the interest rates will not come to the rescue. Again, you have to just put a qualifier on all of these. For all. Expenses eat to multifamily profit. So as they always do. And less this year than last year. Rent growth is poor, but less this year than last year. And it doesn't make sense. Well, I think it depends. Again, less this year than last year. So not wrong, not incorrect, but I think things have changed based on, 2023 to 2024. And again, talking about, further price declines, we talked about the interest of equity. There is a lot of interest from equity. There's a lot of dry powder out there. There's more certainty. And we know we've seen it show up in the surveys, Matt.
Yeah.
And we have a lot of anecdotal experience. Again, just very anecdotal from our own active fundraising experience. We're raising millions of dollars a day right now. We're looking to raise $20 million in a crazy market of uncertainty. We haven't put a deal under contract in 18 months. We finally found a great one. It's it's actually more of a 30% discount if you actually looked at the actual deal in the cap rate compression. The deal would have traded for a 4.5. Now we're buying it for a 6.4. So deals are getting done. There is interest for good deals out there. It's just we're going to see. The question is, when interest rates start coming down, buyers flood back to the market, sellers come back to the market because buyers may be able to pay up a little bit more, but also it's going to coincide with sellers facing reality, which some are doing and some will be forced to do. At some point, Matt, we'll do the full autopsy and expose of the turbulence of COVID to, I don't know when the end point is, maybe never. But I mean, if you think about it, let's say multifamily has gone through crashes, crashing, and I think about our portfolio, and I'm like, okay, well, so if what a crash means to us at Great Capital, not to, because there are deals being foreclosed upon, people finance things. So, but if you buy deals at the right price and you use the right type of financing, which when I'm talking about fixed rate debt, buy at reasonable prices, based on actuals, not too much speculation, with relatively straightforward business plans and stable markets in a crash environment. All of our properties are distributing. We have properties that are throwing off 15% cash on cash a year. Some less. Probably the least is about 4%, and the highest is 15%. Not including some of the cash out refinances that we've been able to get in a year that you can't refinance anything. We did two cash. Well, I guess one was in 24, one was in 23. Two cash out refinances. Out,
in the same high interest rate.
It's a high interest rate environment. We did value add starting in 21. Refinance in 2023, we forced $5 million of value, pulled money out. So you can still do it if you buy right, invest with the right group, not trying to, just talk Great Capital up. But for the asset class, if you think about it strategically, it's an incredible investment asset class. I mean, and it's like if this is the crash, we've gone through a crash, and maybe not. Maybe Scott's right. Maybe we're just picking up. But it's incredibly resilient. But you have to do it right. You can't just do it willy-nilly. It's all about the team.
And that's a good point. So from the perspective of of someone that wants to buy and has made sensible decisions, this is not, you didn't really feel much of a crash, but there are people that did crash.
It's not that it has been an easy period. So we haven't been able to buy assets, and that's just more of like we haven't been able to grow as much. We want to keep growing,
and like we've had to buckle down too and get more efficient, and like that's just a reality.
Expenses were rising. We didn't get growth, and growth slowed down, and it's picked up. Expenses rose. A lot more of just okay, what's the challenge today? We have to work through it and navigate it, and it hasn't been easy. But if you're willing to do a little bit of work, and I don't think we're the smartest people. Just if you can do a little bit of thinking, be smart enough, you can avoid a lot of the pitfalls. Because I don't think that the smartest investor. I think we've just kept it kind of simple, and not overly speculated, and just worked hard to get some good deals.
I agree.
Simple as that. Just do that.
Man, it's so much harder than that. Oh, that's funny.
No, that's all it is. If you like what you hear, make sure you subscribe to the Gray Report on the Gray Capital YouTube channel. We've got a webinar coming up. It's on February 20th. All talking about this River Club deal that we got down in Evansville, Indiana. It's really cool. 17% IRR, strong cash flow. It's accredited investors only. But subscribe to the Great Capital YouTube channel. You'll get an alert. Hit the bell icon, and you get an alert for the webinar. It's at 1 p.m. February 20th. That's a Thursday.
I think it's Tuesday.
Tuesday, February 20th. Thanks, Matt.
No
It's
problem.
a T day. So Tuesday, February 20th at 1 p.m. Eastern Standard Time. Bring your questions. But right now, if you're on the YouTube channel, we've got a whole like deal overview. It's 45 minutes. It's kind of it's basically the webinar, but with no questions. I'm just talking about the deal, going over it. I'm so excited to talk about the deal. I was like, I'm ready to do this webinar. I can't wait until Tuesday. I got to jump in and do this thing now.
Yeah.
And I want to talk about it because I'm excited.
Yeah.
It's a great deal, and so I just lay it all out. You can go check it out on the YouTube channel. Again, accredited investors only. If you're ready to go, you want to download the deck, schedule a meeting, do due diligence, even actually make a commitment for the deal, soft commitment, hard commitment, whatever floats your boat. graycap.net. You create an account on our portal. You'll get access to the deal room. You're in. Again, it's only open to accredited investors. This isn't financial advice. Make some smart decisions. Consult with your own, whoever you consult with. They should be a professional. We like doing good deals, and we want to work with cool people and invest with cool people. So if you are a cool person wanting to invest, get in touch with us. If you are not, you can go invest with all of the other syndicators that are issuing capital calls. I don't know how else to say it.
Yeah, that's great.
Okay. Matt, anything, closing remarks?
No, I think we tied this up really well.
Good.
This was a nice episode.
With a bow.
Yeah.
I agree. Okay. All right. We'll catch you on the next one. We'll see you on the webinar, which I guess will be before the next episode of the Gray Report. Again, that's on this upcoming Tuesday on the 20th. Check out the YouTube show and make a commitment to invest, a couple $1 million in River Club. Get this done. Keep watching. Again, we got $20 million to raise. Are we going to be able to do it? I don't know, Matt.
Yeah.
I'm going to lose, $500,000 of non-refundable money if we don't. I'm guaranteeing the loan. I should be more nervous.
I'm gonna jinx it if I say what I think about how easy it's been to find investors. So I won't.
It's not easy to raise money.
Yeah.
But if you have a track record of discipline, and you just keep doing what you say you're going to do, and we're just
We've
consistent.
been waiting so long for this too.
And we've passed on so many deals.
Yeah.
And happy to pass on a deal that's not good. This one's a good one. Everyone's like, how do you get that price? That's the one thing they're like, how did you get this deal? I don't know. We just said no a lot.
Yeah.
Okay. See you next time.